Hi, this is Nate Williams with Practice Financial Group. Today we're talking more tax strategy, and this one is called Avoid the Tax Trap. Very, very important. First of all, what is this tax trap that you've heard so much about? The tax trap, very simply, is when you owe money in taxes, but you don't have the money to pay. Now, some of you who have worked with other CPA firms have experienced this firsthand. You get surprised with an unsavory tax liability, tax bill that you weren't expecting, and you don't have the money to pay for it. So, how do you get out of the tax trap? Let's assume that you have a 60% overhead and a 40% tax rate, just for this example. If a doctor owes $100,000 in taxes and doesn't have the money to pay, the doctor then collects $250,000 in order to keep $100,000 after the overhead, in order to pay the $100,000 tax bill. But now, because the doctor earned $100,000 more, he now owes $40,000 more in taxes. Therefore, he then collects $100,000 to keep $40,000 to pay the tax bill. But now he owes $16,000 in taxes. The doctor then collects $40,000 in order to keep $16,000 to pay the tax bill, but now owes $6,400 more in taxes, and so on and so forth. You get the idea. This, again, the tax trap is when you owe money in taxes, you don't have the money to pay, and so you're earning money to pay last year's tax, but you're incurring a new tax for this year. So how do we get into this? The easiest way to fall into the tax trap is when you, again, like I said, the tax trap is when you owe taxes but don't have the money. The easiest way to fall into the tax trap is by spending beyond your means. Like when you buy a house you can't afford. Wow, look at this house. This is absolutely gorgeous. Wouldn't you think? Wouldn't we all love to live here? But beware, buying something like this can very quickly push you into the tax trap. Another way to fall into the tax trap is by taking advantage of this famed Section 179 deduction, which accelerates depreciation in the year that you purchase equipment. Let me show you how this can work. In year one, let's assume that a doctor has $500,000 of income, but buys equipment for $150,000, all on debt, so no cash went out the door. And so the doctor's cash income was $500,000. The full $500,000, bought the equipment on debt, so the doctor still has $500,000. But the tax liability was reduced by $150,000, so the tax bill was only $140,000. Okay? This is super awesome. Big party thrown in year one. The remaining cash is $360,000. But a few years later, as the tax deductions are gone, and now the doctor is paying principal on debt, let's assume the same scenario. The doctor now has $500,000 of income, cash income and tax income. There's no deductions from Section 179. We took that years ago. But now this doctor has to make $50,000 in debt payments. So the cash income is $450,000, but the taxable income is $500,000. With a 40% average tax rate, this doctor is going to pay $200,000 in taxes. So the remaining cash, which is the $450,000 cash minus the $200,000 in tax, is $250,000. So in just the space of a few years, this doctor went from becoming accustomed to a $360,000 free cash flow to $250,000 free cash flow. Not good. Thus, putting the doctor in a very potentially tight tax cash situation, which we call the tax trap. In other words, or another way to look at the tax trap is that when you're in the tax trap, your tax rate doubles because you're paying last year's tax and this year's tax. Beware of the tax trap. Don't spend money that you don't have Don't overspend personally. Your personal spending can really affect your tax situation. And also, beware of buying things on debt and accelerating depreciation. As popular as that is in the medical device and dental device equipment world, it's a horrible tax planning strategy. I hope this is helpful.